Investing in the stock market goes far beyond simply buying and selling assets based on daily price fluctuations. Many investors fall into the trap of reacting impulsively to sudden market drops, selling their stocks in panic without truly understanding the intrinsic value of the companies they've invested in. This short-term approach can be extremely harmful as it ignores the fundamental principles that underlie true success in investing. The key to achieving exceptional performance lies in understanding deeply what you are buying. This means studying the companies, understanding their business model, management, financial statements, and long-term prospects. The history of the stock market teaches us that it will inevitably go through periods of decline, and these drops can be significant. However, it is precisely during these times of volatility and uncertainty that the greatest profit opportunities may arise. Knowing how to handle these turbulent moments with calm and clarity is what can truly make the difference between a mediocre investor and a successful one. Peter Lynch, one of the greatest investors in history, brilliantly exemplifies how to turn crises into major profit opportunities. Throughout his decades of experience, Lynch developed a unique approach that allowed him to navigate uncertain times with mastery, identifying opportunities where many only saw losses. Instead of being swayed by market fluctuations, Lynch always focused on the fundamentals of companies, seeking to understand deeply what truly made them valuable and profitable in the long run. His investment strategy, which involved studying companies in detail and investing in them based on their true value, allowed him to grow his fortune extraordinarily, even during market crises. Lynch's ability to remain focused on the fundamentals of companies and not succumb to market panic is a fundamental lesson for all investors. In a world where volatility is constant and market drops may seem threatening, it is essential to change the perspective and view these moments as opportunities. Investors who can see a market downturn as a chance to buy good companies at lower prices may be rewarded with great returns in the long term. This is the true secret to investment success. In this text, we will explore how deep knowledge about what we are buying, combined with the patience to wait for the right moment to take advantage of market drops, can be the key to achieving extraordinary results, regardless of economic circumstances and the state of the market. Understanding the fundamentals of companies and adopting a disciplined approach can turn market declines into valuable opportunities for growth and wealth. But if you don't understand the company, if you are buying only because the stock went from 26 to 16 and then dropped to 10, what would you do when it falls to 9? And when it reaches 8? And when it reaches 7? This is the problem many people face. They sell their stocks because they didn't know why they bought them in the first place. And when the price starts to drop, they don't know what to do. At that point, the only reaction they have is to act impulsively, as if flipping a coin, aimlessly going about it, as if the stock's fate was a matter of luck. They find themselves faced with volatility they don't understand. Now imagine we are learning from one of the greatest investors in history, Peter Lynch, who shows us the importance of understanding what we are buying. Lynch, as the manager of the Fidelity Magellan Fund, was responsible for one of the most remarkable investment trajectories. During the time he led the fund, he achieved an average annual return of 29%, outperforming the stock market for 13 consecutive years. In just 13 years, he managed to grow the fund from $18 million to an impressive $14 billion. After this feat, he retired early at the age of 46. Now, decades later, Lynch shares with the public how he managed to multiply his fortune and how it is possible to do the same, even during sharp declines in the stock market. This knowledge is crucial, especially in the challenging economic conditions we face today. If you truly want to understand the market and build wealth, studying history and learning from what has already happened is essential. What history teaches us is that the market falls, and it falls a lot. The math here is simple. Over 93 years, the market had 50 declines of 10% or more. That is, approximately once every 2 years, the market suffers a 10% drop. This is known as a correction, a term that in practice disguises what is really happening, a substantial loss of value in the market in a short period of time. And of those 50 drops, 15 were even more severe, falling 25% or more. These are called bear market declines. In other words, every 6 years, the market tends to drop by 25%. This is what you need to understand. The market will fall at some point. If you are not prepared for that, you should not be investing in stocks. That's why it's important to understand that when the market drops, especially in a big drop, there is a huge opportunity. If you like a stock at $14 and it falls to $6, this can be great as long as you understand the company's financial health, examine its balance sheets, and realize that, despite the drop, the company is well positioned to recover. In this case, you could expect it to go back to $22 in the future. A return from $14 to $22 would be excellent, but from $6 to $22 is even more exceptional. The secret is being prepared for these drops, knowing they are going to happen, and when they do, seizing these opportunities. It is common to hear people saying they predicted the market's drop after it happened, but the reality is that these predictions are made several times over time. When the market drops, many investors rush to claim they predicted the event, but what really happens is they predict these drops repeatedly, and then, when one happens, they end up being right. The key is understanding what you are buying. If you know what you own, if you have a clear understanding of the companies you invest in, then market drops can be seen as opportunities to buy more shares at favorable prices. One of the most important rules I find useful for investors is that often, people buy stocks based on the fact that their price has dropped a lot. But how far can this price drop? How do you know when it has hit rock bottom? I remember the case of Polaroid, whose stock dropped from $130 to $100. Many people were saying, "Here's a great company with an exceptional track record, and if it ever drops to X price, I'll buy." The problem is that without understanding the company's fundamentals, without knowing what's behind the drop, you may end up buying at a very bad time, when the company no longer has the same solid fundamentals it once had. This is the kind of mistake that can be avoided if you truly understand the company, its products, its market, and its finances. This will give you the confidence to withstand the drops and come out stronger in the long run. Below 100, just buy as many shares as you can. And indeed, when the stock dropped below 100, many people bought based on this reasoning, saying, "Look, it went from 135 to 100, now it's at 95, what a buying opportunity." But within a year, the stock fell to $18, and this happened without any debt. It was such an absurd situation, such a huge overvaluation that the stock collapsed. I went through the same experience in my first or second year at Fidelity with Kaiser Industries. The company's stock went from $26 to $16, and I thought, how much lower can this go? It's at $16. So I believe we bought one of the largest blocks of Kaiser Industries stock on the New York Stock Exchange for $14. I thought, it went from 26 to 16. How much lower can it go? Well, it went down to 10, and then I called my mother and said, "Mom, you need to see this, Kaiser Industries. How much lower can it go?" It went from 26 to 10 inches. But the stock kept falling to 6, to 5, to 4, and finally to $3. And that's when I quickly started to understand that something was very wrong, because Kaiser Industries owned 40% of Kaiser Steel, 40% of Kaiser Aluminum, 32% of Kaiser Cement, as well as owning Kaiser Broadcast, Kaiser Santa Gravel, Kaiser Engineers, Jeep, and several other businesses. And most importantly, it had no debt. I learned this very early on, and this could be a crucial point for some people. It's very hard to go bankrupt if you have no debt. It can be tricky. Some companies may come close, but it's a huge accomplishment if you have no debt. And the entire company, when it was trading at $3 a share, was worth about $75 million. At that point, it was being traded like a single Boeing 747. I thought, something is very wrong here. A company this large, with so many assets and no debt, is being traded for $75 million? I was a bit hasty at $16, but I believed everything was fine, and eventually it worked out. What the company did was distribute all of its shares to its shareholders. They distributed shares from Kaiser Steel, Kaiser Aluminum, public stock, and sold off all the other businesses. In the end, shareholders received about $50 per share. But if you didn't understand the company and just bought based on the fact that the stock went from 26 to 16, then to 10, what would you do when it dropped to 9? And if it went to 8? And when it reached 7? That's the problem people face. They sell their stocks because they don't know why they bought them in the first place. When the stock drops, they get lost and don't know what to do. If you flipped a coin, walked around aimlessly, what would you do? Would you be worried about the volatility of the financial markets today? Do you think something needs to be done to reduce it? Personally, I love volatility. I remember 1972 when the market dropped dramatically and Taco Bell went from $14 to $1. The company had no debt, never closed a restaurant, and I started buying the stock at $7. I kept buying, and the stock went to $1. In the end, Taco Bell was bought by PepsiCo for $42 in 1978. If it hadn't been bought, I believe the stock would have gone to $400. I think volatility is a positive thing. I believe it's very important, and these drops are necessary. What I don't think is good is the market going up 80 points in one day and falling 80 points the next day. That's not good for the public, it's not healthy. But all the measures that help reduce this short-term volatility are important. Even so, the market will continue to have ups and downs. Human nature hasn't changed much in the last 25,000 years, and some unexpected event will make the market fall or rise. Volatility will continue to occur, but the opportunities are great if people understand what they own. If they don't understand, if they are investors who try to guess which mutual fund they are buying and keep adding more and more, the chance of failure is high. Company earnings grow about 8% a year, historically. This means that earnings double approximately every 9 years, and the stock market should double about every 9 years. So I believe the next market will hit 3,800 points. Today it's at 3,700, and I'm convinced the next 3,800 points will be upwards, not downwards. The next 500 or 600 points, I don't know which direction they will go, but the market should double in the next 8 or 9 years, and then double again in the next 8 or 9 years, because earnings will grow 8% a year, and stocks will follow that growth. It's that simple. October has always been a special month for me. I remember 1987 when I was very confident that the market wasn't in trouble, and I wasn't worried about anything. My wife Carolyn and I had planned a big golf trip to Ireland where we would play on one course and then travel along the west coast, playing on other courses. We left on Thursday night, and on the same day, the market dropped 55 points, which wasn't good. The next day we arrived in Ireland, and because of the time difference, we had already completed the day. When I got back to the hotel, I got the news that the market had dropped 112 points. I said to Carolyn, "Look, if the market keeps falling on Monday, we'll need to go back. So let's enjoy the weekend and stay here." But on Monday, the market dropped 580 points, and my fund, which was around $12 billion, dropped to $8 billion. That really got my attention. In just 2 business days, the fund lost a significant part of its value. By the end of that week, I found myself in quite a peculiar situation. Not much fun, to be honest. The scenario seemed beyond my control. There wasn't much I could do, especially since I was dealing with a situation that was beyond my hands. Imagine the picture. It was a Monday, and the market hadn't opened yet. In Ireland, the clock was 12 hours ahead, while in New York, it was only 7 a.m. The time difference meant the stock market was still closed in New York, and the tension was building as signs of deterioration began to appear. I then decided to spend the day in a lighter way, looking for a distraction to forget about the turbulence happening in the market. The morning was dedicated to golf, an activity that helped me relax and relieve the tension. However, despite playing and trying to focus on the game, the market was a constant in my mind. Every hour that passed, I closely monitored the situation and saw the stocks falling dramatically, which gave me a sense of helplessness. I knew the market was in free fall, but I also knew that my position at that moment was clear. I couldn't interfere. As the day went on, the calls started coming in. They were from my shareholders, all anxious and worried about the situation. "What is Lynch doing?" was the most frequent question. Immediately, I imagined the answer they were probably getting from my team. "Well, he's on the 6th hole of golf. He's parked, but stuck in the sand, and this could be a triple bogey. This could be the start of something big. The irony of the situation was hard to ignore. I knew they probably didn't want to hear that. They were expecting an action from me, a change of direction, something that would reverse the chaotic situation. But the truth was, I couldn't change anything at that moment. There was nothing more I could do to alter the course of events. With that, I returned home, and looking at the scenario, I realized that the feeling of suffering was shared by everyone. The market was falling, and there was no way to escape that reality. But despite everything, I maintained my consistency because I knew the market would go through this cycle, as it always did. During the 13 years I managed Magellan, the market had 9 significant drops. And whenever the market dropped, Magellan dropped too. I was 9 for 9, meaning in every drop the fund dropped as well. This number reflects the harsh reality of the financial markets. They are volatile and unpredictable, and no one can accurately predict what will happen next. When you invest, you need to be willing to accept the risk, and that requires a strong mindset, an ability to handle uncertainty and volatility. Something I always try to convey to investors, and I believe it's fundamental, is this. If you put $1,000 in a stock, the most you can lose is 1,000. It can be frustrating and scary, especially when the losses are large and quick. But there's an even more important lesson here. If you're right about your analysis and about the company's value, you can make much more than that. 5,000, 10,000, even 20,000. And in the end, that's the essence of investing. You don't need to be right all the time. You don't need to be right once every 2 attempts. If you're right once every 4, that will be a great success in the long term. The secret is in having patience. When you invest in a company and know it's doing well, that the management is doing the right job, you have the confidence to hold your shares and even add more to your position. The most common, and also the most serious mistake is selling in panic, when the price falls, without understanding what is happening with the company. The key to success is not selling at the wrong time. Holding your position and waiting for the good times is what can lead you to great returns when the market recovers. The real opportunity for profit comes from staying calm and confident in the long run. Now you may ask yourself, where will the market stop? If I could give a definitive answer, I might flip a coin for you. Heads would mean the market will rise, tails that it will fall. The truth is, in the short term, the market is unpredictable. There's no way to know for sure what will happen in weeks or months. But if you look at the long term, you can be sure of one thing. The market will eventually go up. In 10, 20, or even 30 years, stocks will always outperform money markets and bonds. That's one of the greatest secrets of success in investing: time. If you're patient and understand that drops are part of the cycle, you'll have great returns in the future. This mindset should be embraced by any investor, regardless of age or financial situation. It doesn't matter if you have 1 year of experience, 14 or 74 years. The fundamental question is, what will you do when the market falls? I have asked this question to various audiences at large events, and I always get the same response. I ask, how many of you are short-term investors? And I never see anyone raise their hand. The irony is that everyone considers themselves a long-term investor until the market falls. When that happens, people begin to doubt their strategy, question whether they should sell everything, whether they should change direction. But the real key to success is precisely to stay calm and trust the long term, knowing that although the market has its ups and downs, time will be your greatest ally. Investing in the stock market is not a simple task, even for the most experienced, let alone for those just starting. The short-term mindset, often fueled by anxiety in times of decline, is one of the main traps that investors fall into. The impulsive reaction of selling assets when the market is falling may seem like an immediate solution, but most of the time, this approach results in significant losses rather than gains. The stock market is cyclical, with periods of highs and lows, but it is how you react to these cycles that defines your success or failure. Therefore, understanding deeply what you're buying, before anything else, is one of the most important skills an investor can develop. The central lesson from investors like Peter Lynch is that if you understand the fundamentals of a company and believe in its long-term potential, short-term fluctuations can be seen as an opportunity, not a threat. The concept of long-term investing is often cited, but not always fully understood. Many investors enter the market with expectations of quick gains, and when they face the inevitable challenges and declines of the market, they quickly lose confidence and abandon their investments. Successful investing requires patience, discipline, and a deep understanding of the asset you're putting your money into. When you understand the true value of a company, it doesn't matter if the stock price temporarily falls. A company's intrinsic value doesn't disappear overnight. What changes is the emotional behavior of the market. This differentiation is crucial. Knowing that what truly matters is the long-term performance of the company, not its stock price in the short term. The stock market, by its volatile nature, will always be affected by a range of external factors. An economic crisis, changes in government policies, natural disasters, or even geopolitical events can influence stock prices. However, the vast majority of these events will have a temporary impact. History has shown that markets always recover over time, and those who maintain their confidence in their analyses and believe in the resilience of the companies they've chosen are ultimately rewarded. Investors like Peter Lynch intuitively understood this. During the years he managed the Magellan Fund, Lynch not only outperformed the market, but did so with a disciplined approach, focused on understanding companies before investing in them. He believed that the key to success was understanding the fundamentals rather than being swayed by momentary trends. The ability to understand the fundamentals of a company is something that cannot be underestimated. This involves studying its business model, management, finances, competitive position, and future prospects. The price of a stock may fall, but if the company continues to be well managed, with a good product and growth prospects, the price will eventually go up again. Patience in this case is more than a virtue. It's a strategy. Lynch, with his ability to identify companies with great growth potential and his ability to hold these stocks for years, was able to generate extraordinary returns. The lesson he leaves us is that success in the stock market doesn't depend on the ability to predict daily or monthly movements, but on the ability to identify good investments and have the discipline to hold those investments for the long term. The concept of volatility is another crucial point to address. In a volatile market like the one we often experience, the tendency is for many investors to feel uncomfortable with price fluctuations. However, if you look at market movements over the decades, you will see that declines are always followed by recoveries. The key to surviving these periods of volatility is understanding that these moments are, in fact, opportunities. As Warren Buffett, one of the greatest investors in the world, said, "If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This means that when you believe in the potential of a company, you must be able to withstand fear and pressure during difficult times. Declines are natural, but they should not be a reason for panic. Investing in stocks is also about understanding risk. In the beginning, investors may feel uncomfortable with the idea of putting money into assets that could suddenly lose much of their value. However, by investing in solid companies with strong fundamentals and competent management, the risk of bankruptcy or permanent losses is significantly reduced. Although the stock market is unpredictable and subject to fluctuations, risk can be minimized with careful analysis and a long-term investment strategy. Throughout his career, Lynch had to face several market downturns, but his patience and confidence in the companies he believed in allowed him to come out victorious. Investors who, like him, understand risk and know how to manage it have a greater chance of prospering in the long run. Success in the stock market doesn't come from luck or perfect timing, but from discipline, patience, and knowledge. When Lynch managed the Magellan Fund, he knew that it would not be possible to predict all the declines and crises. However, he knew that by focusing on the true value of companies and having the patience to wait for the right moment, he would be rewarded. This is one of the greatest lessons for any investor. The stock market can be unpredictable in the short term, but in the long term, well-selected assets tend to appreciate and provide significant returns. Investing with a long-term perspective, focusing on fundamentals and avoiding impulsive reactions to market fluctuations, is a proven strategy for success. Finally, history teaches us that financial markets are cyclical. There will always be periods of growth and periods of decline. The secret to navigating these cycles is to stay calm, focus on the long term, and understand the assets you are investing in. With the right knowledge and the necessary patience, any investor can weather downturns and come out stronger and wealthier in the long run. This is something that Peter Lynch, Warren Buffett, and many other successful investors know very well. True success in the stock market doesn't come from trying to predict the future or get the perfect timing, but from adopting a disciplined approach focused on the fundamentals of companies. If you can do that, the stock market will offer great opportunities to achieve your financial goals, regardless of the obstacles that may arise along the way.